Now, you have just distributed the operating income. Then you add taxable investment income. Taxable investment incomes shared according to profit sharing ratio. Sharing ratio. So if you have something like rent, non-qualifying dividend, non-qualifying interest, royalty, all those, remember, withholding tax is not final. You'll come and share here according to the profit sharing ratio. This one, total. And then now from there, you can get total taxable income. Total taxable incomes, which will take the operating income plus investment to get the total. Operating plus investment, operating plus investment, there. And now, if you're asked about now taxing, getting the tax payable by partners, you will tax this one A individually on this using the graduated scales, the way we tax a sole proprietor's income. The same case, this one, A, B, tax on this one to get the tax they are supposed to pay. So that is what you need to know when you are taxing the partnership business. And from there now, I want us to look at a question. So I read the question, then I'll show you how it is solved or computed. This is what the question says. And from there now, I want us to look at a question. So I read the question, then I'll show you how it is solved or computed. This is what the question says. Kamara, Susan, and Kubasu are a partnership, trading as Kasuku traders, sharing profits or losses equally. They have provided the following statement of profit or loss for the year ending that 1st December 2021. We have the gross profit, VAT refund, foreign exchange gain, dividend income net, a profit or disposal of furniture, rent income, then total income, then less expenses, insurance premiums, legal fee, depreciation, repair and maintenance, VAT paid, sundry expenses, interest on capital for Kamara, Susan, and Kubasu, motor vehicle expenses, custom duty, accountancy fee, bad and doubtful debts, rates and rent, salaries and wages, net loss. Additional information. Number 1. Insurance premiums include 282,500 paid to insure Susan's private car. Legal fee include parking fine, settling a dispute with a customer, appeal against tax assessment, court expense for breach of contract, preparation of tender documents. Number 3. Sundry expenses include interest charged on hire purchase, cash embezzled by cashier, registration of trademark. Number 4. Repair and maintenance comprised of the following: repair of furniture, installation of surveillance camera, cost of office furniture. Number 5. The partners took goods for personal use which had cost price of 225,000. The gross profit margin was 20% as recorded in the partnership books of account. The investment allowance were agreed with the Revenue Authority at 1475,000 during the year ending that 1st December 2021. Salaries and wages included salaries to the partners as follows: Kamara, Susan, Kubasu. So we are required to have the adjusted partnership profit or loss for that year and distribution schedule of the profit or loss computed in C1 above. So we prepare the income distribution schedule after getting the taxable income. So the first question is to get the taxable income of the partnership. Question is, which method are we supposed to use? Here we said if you are given net accounting profit, then you use the net profit method. Here we are given the net loss, which is a negative profit. That automatically means that you're supposed to use the net profit method. So we solve the question. We start with the name of the business, Kasuku Traders. Which is a partnership. We get the taxable income for the year ended that 1st December 2021. As we had said, when you are given the net accounting profit or loss or income, we start with it and then we adjust it. So we'll start with net loss provided, which we are given in shillings, and we have 2956,000 negative or a loss. Then we add, we had said when you're using the net profit method, you add non-allowable expenses in P&L and taxable operating income not in P&L. Non-allowable expenses in P&L and taxable operating income not in P&L. What does that mean? We usually start with the first item, non-allowable expense in P&L, meaning in P&L is the profit and loss account, which is the income statement. That in this income statement, as you can see, incomes were added and expenses deducted to get the net profit, which is a negative profit anyway. So we are saying, of those expenses that were deducted, is there an expense that is not allowable? So that now it had been deducted to get the net profit. It's not allowable. It's not supposed to be deducted. We add it back. Before we go to the last one, I'll show you where we find it, because that one, as you can see, not in P&L. So we finish with this first one, as we had illustrated earlier on. Let us start with the expenses. We just follow the ones that are in the P&L. Insurance premium. Insurance is for the business, and it is usually allowable expenses. The other one is legal fee. Legal fee is also allowable, as long as they have not extended to what they entail. Depreciation, no. Depreciation is not allowable, as we have been saying, so we add it. It had been deducted, remember, and it is not allowable. 575,000. The other one is repair and maintenance. Repair and maintenance, that is allowable. It's for the business and it's allowable. VAT paid. We said any form of tax we don't allow. Any form of tax. VAT is a tax. Value added tax is not allowable. Had been deducted to get the net profit, and it's not supposed to be deducted. It's not allowable. We add it back. Next, sundry expenses. That those sundry expenses are small expenses put together for the business, and they are allowable. Interest on capital. We had even said it here that anything paid to the partners is not allowable. Partner salary, commission, interest, drawings, in private expense we don't allow. So that one had been deducted and it's not allowable. So interests on capital, which we have Kamara, we have Susan, Kubasu. So Kamara for 7,500. The other one is 185,000. The other one is 146,000. Then we continue motor vehicle expenses. Motor vehicle expense, those are expenses to run the motor vehicle. Don't say it's the cost of motor vehicle. When you hear motor vehicle, they are the expense to run motor vehicle, like fuel, repair. Those are allowable. But if they say the motor vehicle costs, that's now the cost of a motor vehicle. Fixed asset we don't allow. So this is allowable. Next is custom duty. Custom duty is a form of tax. We don't allow taxes. So we'll add it. which we have 227,500. Next one is accountancy fee. Those are professional fee you pay. They are allowable because they are for the business. Bad and doubtful debt. Now when you hear doubtful debt, is a provision, a general provision, because you are doubting that they might not pay, they might pay. So it's just a provision. We don't allow provision unless it's specific provision for bad debt. The next one is rates and rent. Rates and rent, those are allowable expense because they are for the business. Salaries and wages, we also said those are allowable. They are for the business. They are revenue and commercial expenses. Now look, we are done with non-allowable expenses in P&L. Now we can look for taxable operating income, not in P&L. What does that mean? It means that an income that is taxable, but it has not been included in the P&L, in the income statement up here. So meaning it didn't increase the net profit that we have down there, although it's a loss, it's a negative profit. It didn't. So if it is not in the P&L, it didn't increase this net profit. Where do we find it? We can only find it in the additional information. So we go to the additional information to check for an income not in P&L. If it happen to be taxable operating, then we are going to add. However, when we go to the additional information, there's something else we normally check. You see, we say we are done with the expenses in the P&L, but you may go to the additional information and you are given analysis of those expenses that are in the P&L. Like the last expense we had salaries and wages in the P&L. You may go in the additional information and you're told that was to the partner. Remember, salary to the partner we don't allow. So we still come back and disallow it. So in the additional information, we not only look for taxable operating income not in P&L, but we also look for analysis of the expense in P&L. If they happen to be non-allowable, we still add them. Like if you go to the additional information number 1, we are told insurance premium include. Now insurance premium is an expense. When you go to the income statement, you'll find it is the first expense. So now we are to that one, it includes 282,500 paid to insure Susan private car. Those we don't allow. Why? Because they are private expenses of Susan, who is a partner. We don't allow. So we disallow the 282,500. Insurance, Susan car, 282,500. Then number 2, legal fee include. Legal fee is an expense. Now, is it in the P&L? Yes. When you go to the P&L, the second expense, legal fee. Now, we need to determine if there's a component that is not allowable of that legal fee, so that we add it because it is in the P&L. It included parking fine. Parking fine, we don't allow them. Let me analyze them, then I post the one that are not allowable. Parking fine are non-allowable, so that will add setting a dispute with the customer, that is allowable. So if you remember what we said, legal expense related to customer is allowable expense. Then the other one is appeal against tax assessment. We said any expense relating to tax is not allowable. Relating any expense, any form of tax we don't allow. Expense relating to tax we don't allow. So this is not allowable. It's relating to tax. Court expenses for breach of contract. We said that. Legal expense relating to breach of contract we don't allow. The other one is preparation of tender document. Now that is allowable expense. So now let us disallow the ones that we have said. Parking fine. $150,000. Tax assessment. Expense, which we have 62,500. We have breach of contract, costs or expense, 400,000. Preparation of tender that we said is allowed. After that, we go to number 3. Sundry expense include. Now sundry expense is in the P&L. When you go to the P&L, you will find it there. So we need to determine the part that is not allowable. It included interest charged on hire purchase. We had said interest on money borrowed is allowable. Interest on money borrowed. So hire purchase is like you had taken an item through hire purchase, you had borrowed it, so you are paying the interest. That's allowable. Cash embezzled by cashier. We had said any expense that is not income generating, we don't allow. So it doesn't matter who embezzled. As long as it's an embezzlement, it is not income generating. We disallow. We will add it here. The other one is registration of trademark. We had said expenses relating to trademark, patent, copyright, we don't allow them. So these two we disallow. Cash embezzled, by cashier, 565,000. The other one is registration of trademark, which we have 281 to 50. After that, we go to the point number 4. Repair and maintenance comprised of the following. So, repair and maintenance, if you go to the P&L, you'll find it. It is there, one of the expense. So, we check the part that is not allowable. We are told it included repair of furniture. Repair of furniture, those are normal business expense and it's allowable. Don't say it's relating to a fixed asset because it was incurred after the fixed asset had been purchased. It's already allowable. Installation of surveillance camera, that is the one that is not allowable because we had said when we were looking at the capital allowance, expense incurred before you start using a fixed asset. We normally claim capital allowance on them when we are claiming the capital allowance of that particular asset. So this one is not allowable because it's part of the cost of the fixed asset, the CCTV. Cost of office furniture, those are also not allowable because they are fixed asset. So we disallow the two. Installation of surveillance camera, where we have an amount of 812,500. The other one is the cost of office furniture. Costs of office furniture. Cost of office furniture, 525,000. Then we now go to number 5. The partners took goods for personal use which had a cost price of 225,000. The gross profit margin was 20% as recorded in the partnership books of account. So partners took goods, they were charged profit. It's like the goods were sold to them. Now, they were at the rate of 20%. Now, if you go to the income statement to check whether that profit is there, it is in the gross profit that you can see in the income statement. And what did we say about the income in the income statement? At the moment, we are interested with the income not in the P&L, not in the income statement. So if an income is in the income statement, we ignore for now. So we move on to the next one. Investment allowance were agreed with the Revenue Authority at 1475,000 during the year. Remember, investment allowance is equivalent to capital allowance. Capital allowance or investment allowance are allowable. Right now, we want the non-allowable expense in P&L. So that being allowable, we ignore. Number 7, salaries and wages include. If you go to the P&L, you'll find salaries and wages there. In that salaries and wages, we are told it included the one that were paid to the partner. We said anything paid to the partner, we usually don't allow it. So, salaries to the partner. Where we have Kamara, Susan, Kubasu. We have 450 and we have 225. And that is the end of the additional information, meaning we don't have any other item we are supposed to add. Because we are done with the expenses in P&L, unfortunately, we didn't find taxable operating income not in P&L. Otherwise, it could have been in additional information. Now that we are done with the addition, remember we said now you come to the deduction. Deduction, we deduct 3 items. Less, non-taxable operating income, P&L. That is one. The second one is all investment income. All investment incomes in P&L and allowable expenses not in P&L. So we are saying we first look for non-taxable operating incomes in P&L and all investment incomes in P&L before we look at the allowable not, because this one is not in P&L. We start with the first two. Now we go to the P&L and look for them, but I like to delete this part here so that I can continue, and then once we are done I can come and we distribute here. So the continuation is here. So let us go to the P&L, look for non-taxable income, meaning that in this income statement up here, there could be an income that is not taxable that was included. We remove because it increased the net profit there. We remove because it's not taxable. 2, if there is any investment income here, investment income increased the net profit, we remove it so that we remain with operating income only, as we had said. So we start with the first income, gross profit. Gross profit is a taxable income and does not have an issue because we are in the business of buying and selling the goods. So the profit we make is a taxable. But there was additional information number 5, that the partners took goods for personal use which had cost price of 225. The gross profit margin was 20% as recorded in the partnership books. We said any income to the partner is not from the partner is not taxable. So it's like the partners purchase the goods from the partnership because they are being charged the profit. We remove that profit. So profit on goods taken by partner, by partners. So here we are told the goods, the cost of the goods was 225,000. This is the cost. I want to remind you that whenever you are given margin and markup, I know you have done financial accounting or financial reporting. You are told whenever you are given the markup or margin and you want to get the profit, you must be very careful. That, remember, I want to illustrate here. Remember, markup, let me start with the margin. Margin is usually equivalent to profit over sales, which in this case we are told is 20%. So 20% stand for 20 over 100. Now we use the margin the way it is to get the profit if we are given the sale. Now in our question we are given the cost. The cost, we use the markup, which is the profit over cost. So in this case then we have to ask yourselves, how much was the markup? You don't have to worry, you just need to use the margin to get the markup. How? See here we have profit over sales. Margin is profit over sales, which is 20 over 100. Profit, it is 20 then. Sales is 100 then. And here in the markup we have the profit. So bring this 20 here because it is the same. It's a common factor in the markup and margin. Profit, 20. And then now get the cost. Remember, even when we are doing the gross profit method, we were saying a sale minus the cost of sales, we get the profit. Now, if you want to get the cost, remember here we want to get the cost. If you want to get the cost of sales, then take this cost of sales together with the negative to the other side, and the profit will bring here. Remember, profit is positive here. When it come here, it will be negative. Cost is a negative here. When it will go beyond the is equal sign, it will become positive. So it's like saying the cost will be the sale minus the profit. So in this question, do we have the sale? Yes, the sales is here, which is 100. So we take 100 to get the cost minus the profit. Do you have the profit? Yes, the profit is 20. The one that we have even used here, minus 20, meaning it is 20 over 80. So now that we have the markup, and the markup is the one that you use the cost, now we can apply it directly. This is the fraction 20 over 80 times 225, because that is the cost. So we'll come here and talk of times 100 over 80. And not 100 over 80, 20 over 80. 20 over 80. We do the computation so that we can get the profit that was charged on the partners. 225,000 times this 225, let me confirm, is 225. 225 times 20 divided by 80, which give us 56 to 50. So 56 to 50, we minus. Remember, we are minusing because it's an untaxable operating income in P&L. So I'll now continue here. Now we go back to the P&L, look for other non-taxable income and investment. After the gross profit, we have VAT refund. VAT refund is not even an income because you just overpaid your VAT and it's being refunded to you. So we remove VAT refund. VAT refund 102,500. It is a non-taxable income. It's not supposed to be taxed. The other one is foreign exchange gain. We only said the non-taxable foreign exchange gain is the unrealized one. Unrealized we should not tax. Actually, if we were told unrealized, we should have removed because it had been included to increase the net profit and it's not taxable. But when it is cited, what does that mean? It means it is realized. So if decided it is realized, so that is taxable. We want to remove. Dividend income net. Dividend is an investment income, and we said all investment income in P&L or investment income in P&L, we remove them. So we remove dividend income. And somebody may ask, do we remove the net of the gross? My answer is, you remove the figure that increased the net profit. The figure there, whether net or gross, right now they are saying net 562.5. The 562.500 is the one that increased the net profit that we are adjusting. So remove it, whether gross or net. The figure is the key, 562,500. Then profit on disposal of furniture. If you remember, we said income from selling fixed assets we don't tax. So had been included in the in the income statement, they increased the net profit, it is not taxable. So profit on furniture. So profit on furniture, which we have 591,000. The other one is rental income. We said all investment income in P&L we remove. Rent is an investment, we remove rent income, which we have for 15,000. And that is the last income in the P&L. So we are done with non-taxable operating income in P&L and all the investment income in P&L. Now we look at the last part, allowable expense not in P&L. An expense that was supposed to be deducted in the P&L in the income statement to get this net profit, it had not been deducted, meaning this net profit, it is overstated. So we need to remove it. If it is not in the P&L, where do you find it? You find it in the additional information. Let us go to the additional information for an expense allowable not in P&L. Now we start with number 1, insurance premium. Now remember, we want expense not in P&L. Insurance premium is in the P&L. Leave it. Number 2, legal fee. Legal fee, if you go to the P&L in the income statement, you'll find it there. Leave it. Including, don't say, like in the legal fee, we are told it includes setting a dispute with the customer and also preparation of tender. Remember, those we said are allowable. Don't go to the P&L and you won't find them and say now they have not been deducted. No, all of them are in the heading of the legal fee. So they are all inside the legal fee that is in the P&L. So as long as the heading is in the P&L, ignore it. So number 3, sundry expense is in the P&L. Repair and maintenance is in the P&L. Number 5 was about gross profit, not even an expense. Number 6, investment allowance were agreed with the revenue authority to be 1475,000 during the year. Now, investment allowance or capital allowance, it is allowable. It had not been deducted, because if you go to the P&L, you will not find it having been deducted there. So we deduct. It is allowable expenses, not in P&L. Investment allowance written as that, in short, or CA for capital allowance for the year. For the year. For the year. For the year, which is how much? Here we are told it was agreed to be 1475,000. 1475,000. We continue getting the allowable, not in P&L. Number 7, salaries and wages include. Salaries and wages is in the P&L, and there is no other expense that is not in P&L. However, I want to mention this. Sometimes you may not be given this investment allowance agreed. Like you may not be given that point number 6. Let's say it is not there. If you are not given, make sure you come back to the expenses that you disallowed. Check if you have a fixed asset. Remember, fixed asset we disallow so that we come and allow the capital allowance. Allowable expense not in the capital allowance. So if you are not given this, like in this case, we had which fixed asset? Here we had installation of CCTV. If you remember, we said capital allowance is at the rate of 10%. And then the next one is the installation of CCTV. There was office furniture, cost of office furniture here. Remember, office furniture, we are supposed to claim at the rate of 10% as well. So if you are not given this capital allowance, we could have come here and say capital allowance on installation of CCTV camera, 10% of the figure that we have, 812,500, we minus that figure. Then capital allowance on furniture, 10% of 525,000, we get the amount before. But if you are given the capital allowance, then you are okay. So with that one, then we are supposed to now get, since there is no other, we have considered every factor here, we can get the net taxable operating income. So taxable operating income, I want to do that first. So what we do, we start with this negative, we add all these figures, we minus these figures so that we can get the net. So I'll start. The first one is 2956 negative. Remember to minus negative. 2956,000 plus now positive 575,000 plus 233,750 plus 407,500 plus 185,000 plus 146,000 plus 227,500 plus 155,000 plus 282,500 plus 150,000 plus 62,500 62 did it first plus 62,500 plus 400,000 plus 565,000 plus 281,250 plus 812,500 plus 525,000 plus 600,000 plus 450,000 plus 225,000. Then now we start minusing 56 to 50. We minus 102,500 minus 52,500. We minus 591,000 minus 415,000. We minus 1475,000. So giving us 125 to 50. So we have 125 to 50. Now, having gotten the taxable operating income, having gotten the taxable operating this one, I want you to get the difference with the sole proprietorship and also the company. For the partnership, we don't add investment income here. Investment income, first we have to distribute this operating income among the partner until here we get the total taxable operating income. So the total we get here will be the same as this. And then the investment income we add here. So the investment income are not added here. They are added in the distribution schedule. So for now, this, we cross it that way for the partnership, because now we need to distribute. Now after that, we have answered required one. We were supposed to get the adjusted partnership profit or loss for the year. Here it is. Required two, distribution schedule for the profit or loss. We have answered required one. We were supposed to get the adjusted partnership profit or loss for the year. Here it is. Required two, distribution schedule for the profit or loss. So distribution schedule is the way we had said. So we'll come and now distribute whatever we have determined. So I'll delete just part of this. And then I'll also change the names here because they are two. And then I'll also change this. Let me delete this. So I'll call this the partnership name, Kasuku Traders Partnership. Income distribution or allocation schedule. And then here we noted there were three partners, by the way. So I'll delete this so that I can introduce the three partners. I'll give them the initials. As we have seen, there's Kamara. So I write KA to stand for Kamara, Susan, SU, and Kubasu, KU. And then totals, because of the space. So shillings, 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 shillings. So we had said the first thing we normally distribute is the salaries to the partner. So you just need to go to the question and determine if there was salaries to the partner. When you read through from the income statement, there was none. Additional information number 1, 2, 3. It was in point number 7. So you come and say now salaries to the partner, Kamara, 600,000. Susan, 450. Kubasu, 225,000. And now we get the total. We add the 3 to get the total. So 600,000 plus 450,000 plus 225, which give us total of 75,000. There. Then the second one is interest on capital. This one, when you go to the income statement, you have to remember the 4 that we talked about first. The salary, interest on capital, commission or bonus, there's interest on drawings, those 4. So you follow them that way. The next one is the interest on capital we had written. So we check. It is there in the income statement, interest on capital. So we would have here 47,500. The other one is 185,000. The other one is 146,000. And now we get the total. So 407,500 plus 185 plus 146, which give us 738,500. Then the other one that we had here was the commission or bonus to partner. But I'm very sure as we went through the question, there were no commission or bonus to the partner. So if it is not there, ignore, just assume it. You go to the fourth one, raise interest on drawings. In the question, we didn't have interest on drawings to the partner, none. So now we do the last one, fifth one, which we said is the profit share. Profit share. So profit share, how do you get? We said we take the operating income, this one, of 125 to 50 minus what you have distributed. You have distributed this and this, which is 75,000 and also 738,500. Then what remains, you share according to the profit sharing ratio. That's what we said. Profit share, you share according to the profit sharing ratio. If you look at the first paragraph, is where we have the profit sharing ratio. Kamara, Susan, and Kubasu are in partnership trading as Kasuku, sharing profit and losses equally. They are three, each to get a third. So first one, a third. The other one, a third. The other one, a third. So let's see what remains. We'll start with 125 to 50, and then we minus 1275,000, and then we minus 738,500. Then we have negative. It will be negative. We have negative 1888. So I'll extend this a bit. 250, which is a negative. Now each is supposed to get a third, so you divide by 3, because it's for each, and the other one is 629,417. All they are, remember, are negative. So from there now we need to get the total taxable operating income. Operating income. So total taxable operating income would mean we take this plus this minus this, because it's a negative. The same case for everyone. So we start with 600 for the first one, 1,000 plus 407,500 minus 629,417, and then we get positive 3. So this would be 378,083 positive. And then now we go to the second one for Susan for 50,000, and then we add 185,000 minus 629,417, 5583. Then for Kubasu, 225,000 plus 146,000 minus 629,417. This is a loss of 258, so negative 258,417. Then now we get the total, which would be 1275,000, and then we add 738,500, and then we minus 1888,000 250, which we get 125 250, 125 250, and that answer you'll find it is starting with the operating income, because remember we have been distributing this operating income. Actually, we can even write it here, 125 250. So at the end, the total column should tally with the operating income, because we have distributed through salary, interest, and profit share. Once you do that, now we said the investment income come here. You add the taxable investment income. Taxable investment incomes. So for the taxable investment incomes, so we need to go to the question, especially in the income statement, determine if we had an investment income, and then we share if it is taxable. The first investment income in the income statement is the dividend income, which we are told it is net. What we say is this: if you are given an income like dividend or interest, and you're not told where it's coming from, always assume it's a non-qualifying dividend or non-qualifying interest. Like this one, they have not indicated where it's coming from. So being non-qualifying means that the withholding tax was not final. We need to tax it further. So the dividend that we don't put here are the one that we indicated as exempt or qualifying, because exempt are not taxable. And here we are talking about taxable. Qualifying, withholding tax, it's final. You are not supposed to tax it again. So only non-qualifying. So this one, being that it has not been indicated, we assume it's non-qualifying, so it should be here. So dividend income, where we have 562,500, and then it is net. Remember, we said that for non-qualifying dividend, if you are told net, withholding tax is 15, meaning they have already deducted 15, meaning this is 85%. Remember, we said you only tax the gross. So if this 85, 100 will be what? To get 100, multiply by 100 over 85. And then profit sharing ratio, each was to get a third. A third. So it will be 562, 500. We multiply by 100, divide by 85. You get 66, 61, 764. Uh, 765, we round off, and then divide by 3, which comes to 220, 588. Now with that one, we have distributed the dividend. There is another investment income, rent. We said if you're not told where the rent is coming from, you assume it's a commercial rent, so that you tax it further. So here we have not been told. And then for the rent, you must minus the allowable expense relating to rent. Repair, caretaker salary for the rental. But for this question, we haven't been told whether there were any expense relating to rent. So we distribute the way it is. So rent income, which we have a 415,000, and then profit sharing ratio, each to get a third. So that would be in total 415 divide by 3, giving you 138,333. 138,333. And then since there is no other investment income, we can now get total taxable incomes. So total taxable income, we do them this way. If the operating is positive, that's the time that we add investment. Like this one is positive. But if it is negative like this, we don't add. we close it there. Remember, we say that a loss from one activity can only be deducted against profit of the same activity. So operating for this guy, this person, they had a negative. It will be carried forward to next year. So next year, when they generate a profit, he generate a profit or she generate a profit from the operating, she deduct this loss. So for this year, he will be taxed on the investment income only. So for this one who have positive are the one that we add. The negative we don't add, we only add the positives. So we start with the first one, 378,083. 083 plus 220, 588 to 2588, and then we add 138 333, which give us 737 004. We go to the next one, 5583, and then we add to 20 588 to 2588, and then we add 138 333. We get 364 504. For this one, remember we said we don't add the negative, carry forward to next year, we only add the positives. So 220 588 plus 138 015. Yeah. And the question ends there. And this total cannot be the same as this way because this we didn't add, so this we carry forward to next year. So as per the question, that is where we stop, and that is how we determine the taxable income of the partnership, and we do the distribution. For now, we are going to stop there until I see you in our next lesson, where we are remaining with one business, that is the limited company. We see how limited companies are usually taxed. Thank you very much. However, make sure that you do the assignment that is being shown at the end of this video. Thank you very much. Hi there, my name is Patrick Kamau Kamure. You are a lecturer in public finance and taxation. Welcome to today's lesson. Today we continue from where we stopped last time. Remember, the topic we are looking at the moment is called the taxation of the business income. And we said that there are three businesses that we need to look at how they are usually taxed: the sole proprietorship, partnership, and the limited company. So far, we have looked at the sole proprietorship. Last lesson, we did look at we started looking at the partnership, whereby after looking at how partnership is usually taxed, we went ahead and we used the net profit method to get the taxable income of the partnership. So today we continue with the same lesson, but we look at another question where we used a different approach to answer the same question, a different question using now the gross profit method. Welcome to today's lesson. So we are going to start by reading the question. After reading the question, then I'm going to help you solve the question. So here is the question. This is what the question says. Karimu and Shika commenced trading in partnership as Kashi on January 2019. They share profits and losses in the ratio of 2:1 for Karimu Shika respectively. The partners were to receive monthly salaries of 18,000 and 22,000 for Karimu Shika respectively. The partnership did not maintain complete set of accounting records. The following summary of the bank statement for that year has been presented to you. So we have the receipts consisting of capital introduced, Karimu and Shika, cash sales, receipts from debtors, sale of a van. We go to the payment side: equipment of office, rent for go down, salaries and wages, purchase of for resale, repair and maintenance, insurance, interest expense, motor vehicle expenses, sundry expenses, motor van purchased, tax penalty, electricity, medical expenses, balance carried forward. Additional information: number one, the following payments were made in cash from the cash sales before banking. We have the motor vehicle expenses per annum. wages per annum, sundry expenses per annum, weekly drawings for Karimu and Shika. During the year, discount received from the supplier amounted to 132,500, while the discount allowed to customers amounted to 118,000. As at that 1st December 2019, electricity and insurance prepaid were 25,000 and 12,800 respectively. Depreciation was to be provided on equipment at 10% on a straight line basis. As at that 1st December 2019, the amount owed to supplier was 780, while the amount owed by the customer amounted to 1420. An amount of it 2,000 owed by Jamila Mamba, a customer, proved irrecoverable and is to be written off as bad debt. This amount was excluded from the total amount owed by a customer as at that 1st December 2019. Salaries and wages include the salaries to the partners. The go-down had been occupied since 1st November 2019 at an annual rent of 450,000. Included in the interest expense is the interest on partners' capital contribution at the rate of 5% per annum. The wear and tear allowance, and it's good to note that wear and tear allowance is the same as the capital allowance. So wear and tear capital allowance was agreed with the Revenue Authority to be 112,000 for the year ended at 1st December 2019. So number 11, closing inventory was valued at 620,000 on 31st December 2019. Assume that year of income had 52 weeks. Required, 1, adjusted partnership profit or loss for the year 2019, and number 2, distribution schedule of the profit or loss calculated in C1 above. So the first question is to get the taxable income, and we say that whenever you are told to get the taxable income of any business, you either use the gross profit approach or the net profit approach. Net profit approach, we said, is when you have been given net accounting profit or loss or income somewhere. If you haven't been given, you use the gross profit method. So this question, we are not given the net profit or loss or income. So automatically we use the gross profit method. Now gross profit method, we said, we usually start with the sales. We less the cost of sales. Cost of sales, we take the opening stock plus purchases, less closing stock minus any item that reduce the stock. And then we get the cost of sales. We less from the sales, we get gross profit. And the reason why we call it gross profit, we said. And then you add other taxable operating income, and then you less the allowable expenses. So, but we said before you start, always confirm. Do you have the sales? Do you have the total purchases? If you don't have, or you haven't been given, then in that case you have to determine them first. So in this question, we take note that we're starting with the sales. We are given only one, the cash sales. But the cash sales does not represent the total sales. We have to look for the credit sales. We add to the cash, we get the total. So now, we are not given the sales, so we have to look for it. The other one is the purchases. Have we been given the purchases? Yes. In the payment, in the statement of bank statement, there is a purchase for resale, but that is a cash purchase. Now, how about the credit? So in this case, we have to determine the credit purchase so that we can add to that cash, we get the total purchases. So this is what we said you normally do. To get the total sales, you do it this way. You say total sales is equals to credit sales plus cash sales. We said for the cash sales you'll be given, it is there, like we have seen this already there. The issue is about the credit sales, where you have to determine it. Now, the best way to approach the question, we said, leave a space like 2 lines, where now you'll be able to open the debtors or receivable account to determine the credit sales. So you'll come here and have the debtors stock receivable. You start with balance brought down here. That's what we said for the debtors. And then jump 4 or 5 lines here where you'll be posting those items that affect the debtors. And then balance at the end here for the debtors. And then totals will be here. Same case on the purchases. We say total purchases is as a result of credit purchase plus cash purchases. For the credit purchase, we jump a space of 2 or 1 line, And then we have the creditors or payables account, where we will be able to get the credit purchase. Then for the creditors, you start with balance pro down here for the creditors, and then jump 4 or 5 lines, then have the balance carry down for the same creditors. And then you'll be able to post everything and the totals there. Once you have done that, now go through the whole question. If you come across some cash sales here, something affecting the debtors here, cash purchase here, anything affecting the creditors here. So we start. From the first paragraph, the only figures that we have are 18,022, which were monthly salaries to the partners. So those do not affect, so we ignore. We go to the receipt. Capital, introduced, that's not. Cash sales, yes, here. So we post it here, 12,700,000. And then receipts from debtors. Receipts from debtors, we said it reduces the debtors. Here, receipts, which we have 5,200,000. Then sale of motor van, that doesn't affect. We go to the payment side. Equipment for the office, that does not affect. Rent for the go down doesn't. Salaries and wages, no. Purchase for resale, yes. Here, that's a cash purchase, of which case we have 9,900,000. The other one is the repair and maintenance doesn't affect. Insurance, interest, motor vehicle, sundry expense. Motor vehicle purchase, that's a fixed asset, not goods. Remember, what we are looking for are for the goods. Tax penalties, electricity, medical expense, balance carried forward, those do not. Then we go to the additional information number 1. The following payments were made in cash from cash sales before banking, meaning what went to the bank, as we can see, the bank statement was this. But before that figure was posted, not really this one, but the one in the bank statement, we had 12,700, this one. But before they banked the 12,700, they had paid some expenses, meaning our cash sales was more than what was banked. So to get the how much it was, we need to add the one that was sold on the one that was sold on cash and then used to pay the expenses. Which one? Motor vehicle expense. So the key thing there was from cash sales, were paid from the cash sales. Motor vehicle expense per annum, that we had 138,000. The other one is wages, 162, plus sundry expenses per annum, 35. Then weekly drawings by Karimu and Shika. So weekly drawings for the whole year, it has to be for the 52 weeks. So 52 weeks times, now weekly for the total, which is 7,200 plus 6,400. And that ends there. From there we go to number 2. During the year, discount received from the supplier amounted to 132,500. Discount received reduces the creditors, so we'll have it here. Discount received, which we had 132,500. The other one, while discount allowed to customers amounted to 118,000. Discount allowed, which reduces the debtors. Discount allowed, which we have 118,000. I want to bring this one a little bit up here, but I haven't changed anything. It's just this. And so we had said the balance carried down for the creditors. We leave it there. So we continue. after that, we go to the point number 3. As at 31st December 2019, electricity and insurance prepaid were 25,000 and 12,800 respectively. That doesn't affect. Depreciation was to be provided on equipment at 10% straight line. No. As at 31st December 2019, the amount owed to supplier was 780. Now, this at the end of the year, what the supplier are owing is 780,000. And then, while the amount owed by customer 1420. What is owed by the customer is 1420 at the end there. We continue. An amount of 82,000 owed by Jamila Mamba, a customer, proved irrecoverable and is to be written off as bad. This amount was excluded in the total amount owed by the customer as at 31st December 2019. So that's a bad debt written off. Bad debt written off reduces the debtors written off, which we have 82,000. 82,000. The other one is number 7. Salaries and wages include salaries to the partners. That doesn't affect. Number 8, go down had been occupied since 1st November 2019 at an annual rent of that. Doesn't affect. Included in the interest expense is the interest on partners' capital contribution at the rate of 5% per annum. Doesn't affect. The wear and tear allowance was agreed with the Revenue Authority to be 112,000 for the year 2019. Doesn't affect. Closing inventory was valued at 620 on that 1st December 2019. Doesn't affect. So we are done. So from there we do the computation. So we are going to add the totals on this side and compare to the total on this side. Actually, we have seen the balance brew down is 0 and also balance brew down here because we started or they started the business at the beginning of the current year. So there was no balances from last year. So it's all about the total on this side will be now the credit sales here. Credit sales. So we add them 5,200 thousand plus 118,000 plus 82,000 plus 1420, which gives us 6820,000. And this one 6820 should be the totals 6820 because we now have written the balancing figure. So then this one we transfer it here 6820,000, which we should be able to add now the cash. So we'll start by taking 7,200 plus 6,400 times 52. So it will be 7,200 plus 6,400 times 52 weeks because that was per week. That becomes 707,200 plus 35,000 plus 162,000 plus 138,000 plus 700,000. Then now we add this one plus 6820,000. 6820,000 giving us 20,200,200. That is the total. We come here, we add this plus this. This is 0, so that will be the credit purchases. So this plus this 132,500 plus 780,000. So that will be 912,500, which will be here 912,500. 912,500. We transfer that one here 912,500, and then now we add the cash purchase. So plus 9,900, which give us 10,812,500 there. With that one now we can prepare the statement of determining the taxable income. So we'll come here, the name of the partnership is Kashi Enterprise Partnership. We get the taxable income for the year ended. 31st of December 2019. So we start with the sales, which we had determined 20, 562,500. Then we less cost of sales. Cost of sales, which we take the opening stock. But here you'll note that we were not given the opening stock because we started the business at the start of this year. So there were no opening stock from last year. So 0 plus the purchases. Purchases is what we have determined here. 10, 8, 12, 500. Then we minus the closing stock. Closing stock is the one given in point number 11, 620,000. So minus 620,000. And then we also minus any item that could have reduced the stock during the year. Damaged, withdrawn stock, stolen, of which case the whole of this question, we didn't have any stock that was stolen, damaged, or withdrawn by the partners. There was none. Let me confirm properly. There wasn't any. The drawings that we are given in additional information, number 1 was cash drawings, not goods. So in this case, we cross to get the cost of sales. Cost of sales, which will be the 10, 8, 12, 500, you minus 620,000. And that gives us 10, 192, 500. And then we can be able to get the gross profit. Gross profit will be, we minus that from 20, 562, 500. And that gives us 10, 370,000. Then we said this, after getting gross profit, and the reason why we call it gross profit method is to add other taxable operating income. Other taxable operating incomes. Other taxable operating incomes. Of which case we said you jump a space of like 3 lines and then you less. I want to bring this one here, 1,000. So you less allowable expense after jumping around 3 lines. Allowable expenses. So what we do now, we go through the whole question. If we come across a taxable operating income, an allowable expense, we post here. We start from the top. The first paragraph was about the salaries to the partner. We said anything to the partner we don't allow. It's an expense yet, but not allowable, so we cannot post. We go to the summary of the bank statement. On the receipt side, capital is not an income or an expense. Cash sales, we used it to get the sales. Receipts from debtors, we used it to get the sales. Sales from the van, we said income from selling fixed assets, we don't tax, so we cannot post here. We go to the payment. Equipment. Equipment is a fixed asset, which we should claim capital allowance at the rate of 10%. But we won't do that. Why? If you look at additional information number 10, we are told the wear and tear allowance, which we said is the same as capital allowance, was agreed with the revenue authority to be 112,000. So that's the one that we use. Anywhere we require to compute capital allowance, we use that. So we can even post it now. The capital allowance, also called WTA or wear and tear allowance for the year. It was agreed to be 112,000. From there, we go back to where we found that in the bank statement. After equipment, rent for go down. That's an allowable expense, rent expense. But we have an additional information to that rent. If something has an additional information, check it out. In additional information number 8, the go down has been occupied since 1st November 2019 at an annual rent of 450. So annual is per year. And now it was occupied from 1st November. Those are 2 months. So forget about the one that you are given. Use the one that you can get for this particular year. So in this case, we are going to take 2/12 times the 450 because it was only occupied for 2 months to the end of the year in this particular year. So this is going to be 2/12 times 450. That will be 75,000. That is the one that we allow. Any other, we forget. Then we go back. After the rent for the go down, salaries and wages. That is allowable. But we have to check whether it is mentioned somewhere else. Salaries and wages. Yes, it had been mentioned in additional information number 7. The salaries and wages include the salaries paid to the partners. Salaries. And here they have made it very clear that it is salaries and wages. Another place that we have wages now mentioned is number 1. The following payment made through the cash from the banking. So we have the wages. So what do? We'll come here and have the salaries and wages. So we open a bracket. Remember, we want to know the allowable salaries and wages for this year. 890,000. And then now we have to add the one that was paid through the cash. This was through the bank. The cash was 162. And then number 7, it includes the one paid to the partners. So we have to remove because we said anything to the partners we don't allow. To the partners was how much? In the first paragraph is where we were told the monthly salaries to the partner was 18 and 22,000. Monthly, underline monthly. So meaning to get to the whole year, we have to take minus 12 times 18,000 plus 22,000. So that we can get, and since it is not mentioned somewhere else, we do the computation. So we take first of all the 18,000 plus 22,000, and then you multiply by 12 months because it was monthly. We get for 80,000. Then we remove them from this. So we take 890 plus 162 minus 480. That gives us 572. That's the one that we should be allowing there. After that, we go back to where we found the salaries and wages. After salaries and wages in the bank statement, purchases for resale, that we used to get the purchases up there. Repair and maintenance, that is another allowable expense. Repair and maintenance. So we check if it is mentioned somewhere else. There isn't. So we just pick the figure as it is, 860,000. After that, we go back. After the repair and maintenance, there is insurance. Insurance is also a allowable expense. So we have insurance. Is it mentioned somewhere else? Yes. Additional information number 3. As at 31st December 2019, electricity and insurance prepaid. So this was prepaid and it's at the end of the year. We said prepaid at the end of the year is for next year, not for this. Anything that is not for this year, we minus. So we are going to take the insurance of 62.5 and then we minus the prepayment which we have 12,800. That will give us how much? This will be 62. 500, we minus 12,800. That gives us 49,700. After that, we go back to where we found the insurance. After the insurance, there is interest expense. Interest, we said, is allowable. So interest expense. But it is mentioned somewhere else. In additional information number 9, included in the interest expense is the interest on partners' capital contribution at the rate of 5%. Included in interest. Anything to the partner we don't allow. So we will take this interest, which is 612,000, and then we minus the one that was paid to the partners, which was 5% of the capital. The capital is in the bank statement, where we have for the two partners 3,500 plus we have the 2,500, that is 2,500,000. That. So we add the capitals, which are 35 plus 25 times 5%, which give us 300,000, and we minus from 612, that give us 312,000. That's the one that is allowable, the one paid to the partners. Then we go back after the salary, after the interest, motor vehicle expense. Motor vehicle expense is allowable, and we say that is not the cost of motor vehicle, it's the vehicle expense incurred to run the motor vehicle, fuel, repair. So in this case, that is allowable, not a fixed asset. Motor vehicle expenses, where we are told the motor vehicle expense is 186,500. After that, we have sundry expense. Maybe there is something that I should have confirmed. In additional information number 1, there is more motor vehicle expense. The one that was paid in cash, 138. We forgot about that, so we should add it. So it will be 186,500 plus the one that was paid cash, which we have 138,000. 138,000. We check if it is mentioned somewhere else, but the motor vehicle is not mentioned anywhere else. So what does that mean? Then that means that we do the computation. 186,500 plus 138,000, which we get that 245,000. That 245,100. Then we go back after the motor vehicle expense. We have sundry expense. Sundry expense is an allowable expense, so we continue. Sundry expenses. And this one again, it is mentioned somewhere else in additional information number 1, the one that was paid through the cash. So we'll have 218,000, and then we add the one that was paid through cash, which we have 35,000, which we have 218 plus 35,000, which give us 253,000. Then we go back after the sundry expenses. Motor van purchased, that's a fixed asset which we should claim capital allowance. But remember, we were already given the capital allowance, so we ignore. Tax penalties, we said any expense relating to tax we don't allow. Electricity expense, that is allowable. So electricity expense, but we check for the additional information. If you go to the additional information number 3, we had electricity prepaid, and we said prepaid is for next year. So that one we need to remove. We need to minus, because of what was paid this year of the electricity, 45,800. Part of it is for next year, and so we should minus from here, where we have the 25,000. That gives us 2,800. Then we go back to where we found that. After the electricity, there is medical expense. Medical expense are allowable unless we are told it was relating to the partner, which we haven't been told. So medical expense. Medical expenses, 630,000. Then now we go to the additional information for any taxable, operating, or allowable expense. Additional information number 1, the following payments were made in cash from cashes. Motor vehicle expense we have considered. Wages we have. Sundry expense we did. Weekly drawings, those are not allowable expenses. Additional information number 2. Those are the figures for the balances of debtors and creditors at the end of the year. So they are not incomes or expenses. Number 3, we have already adjusted for them. Number 4, depreciation. Remember we said depreciation is not allowable. We claim capital allowance instead, which we have been given. Then number 5, as at 31st December 2019, the amount owed to supplier was 780, while the amount owed by customer was 1420,000. That we had said actually there's additional information we jumped. Number 2, during the year, discount received from the supplier amounted to 132,500, while the discount allowed to customers amounted to 118. Discount received, that we know is a taxable operating income, so it should come here. Discount received, that is a taxable operating income. And we have the discount received of 132,500. And then we have the discount allowed. Discount allowed is an expense and it's allowable. Discount allowed. Discount allowed, which we have been given as 118,000. There. From there we continue. We were actually in point number 5. That's where we were saying that we had the balances at the beginning and also at the end. And then from there, number 6. An amount of 82,000 owed by Jamira Mamba, a customer proved irrecoverable, and it is to be written off as bad debt. This amount was excluded in the total amount owed by the customer as at 31st December 2019. That is a bad debt written off, which we said is allowable expense. So we'll have bad debt written off. Bad debt written off, which we have an amount of 82,000. After that, we go to number 7 now. Salaries and wages include the salaries paid to the partner. Now that we had adjusted in the salary here, if we had forgotten, now you should be able to adjust. Number 8, we had adjusted on the rent. Number 9, we had adjusted in the interest. Number 10, capital allowance we had posted. Closing inventory that we used to get the cost of sales here. There is nowhere else it's supposed to be used. Now that is the end. What remains, and this being a partnership, it should end here, is to get the net taxable operating income. So how do you get the net taxable operating income? It is the gross profit plus discount received minus these expenses. So we do the computation. So we start with the 10. There is 70,000 plus 132,500 minus 112,000 minus 75,000 minus 572,000 minus 860 minus 49,700. Remember this was 7. 49,700 minus 312 minus 324.5 minus 253 minus 2,800 minus 630 minus 118 minus 82,000. That gives us 7,093,500. And that answers required 1, where we are supposed to get the taxable profit of the partnership. With that one, we are supposed to go to the required number 2, where we do the income distribution. So the income distribution schedule, this is what we said or how it is supposed to look like. So income distribution schedule. We start by distributing the operating income. So we will start with taxable operating incomes, which is the one that we have determined here, 70, 93, 500. And then now we list the partners that we have, which we have Karimu, Shika, and now the totals. So we go through the question. Remember, we start by looking for the first four items that we said: the salary, interest on capital, commission or bonus, less interest on drawings. Those four. So if you look at the first paragraph, we had the salary to the partner, salary, which we were told it was per month. So the first one was to get 18,000 times 12. The other one was to get 22,000 times 12, because they were monthly amounts. So we have 18 times 12, which give us 216,000. So 216,000. The other one is 22,000 times 12, giving us 264,000. And now we have the total plus 216, 480. For 80,000. Then we go to the capital, to the cash bank statement. In the bank statement on the receipt, we had capital, which is not one of the item we are posting. You go to the payment side, there is none. You go to the additional information, number 1, drawings we said we ignore. Number 2, no. 3, no. 4, no. 5, no. 6, no. 7, we have posted. 8, no. 9, there is interest on capital. So interest on capital, which is supposed to be 5%. 5% of the capital. How much is the capital? In the bank statement, we have capital of 35. And also, the other one is 25 for each. So we start with 5% of 35, which gives us 175,000. The other one is 25 times 5%, giving us 125,000, and the total gives us 300,000. Then after that, point number 10, none, and 11, there is none. So the only remaining one is the fifth one, profit share. How do you get the profit share? We said you take the taxable operating income we have, like in this case we have 70, 93, 500, and then you minus what has been shared already. We have shared the 480,000 and also shared the 300,000. So whatever remains you share according to the profit sharing ratio. And what was the profit sharing ratio? In the first paragraph, they were sharing 2 to 1. So the first one will get 2 out of 3. The other one, 1 out of 3. So let's minus 70, 93, 500. We minus 480. And also we minus 300,000. 480,000 and 300,000 give us 6313. So 6313, 500. Then the first one will get 2 over 3. That give us 4209. 4209, 900. 1,000, sorry. And there now the other one. We can take the 6313, 500 minus what we have given this. 63, 13, 500. That will give us 2104, 500. And now we can get the total taxable operating income. total taxable operating income. So for Karimu, it will be 216,000. We add 175,000. We add 4209, which we get 4,600,000. The other one will be 264,000. We add 125,000, and then we add 2104, 500, which gives us 2493, 500. And now the total, which would be 480,000 plus 300, and then we add 63, 13,500, which give us 1793, 500, and which is the same as the operating income we had determined. Remember, if we had an investment income that is taxable for this question, after getting the operating income, we add taxable investment income, and we share and then get total. But the whole of this question didn't have an investment income. So meaning our question then should end here. So this one will give us now the total taxable income, which should end there. That is how we tax a partnership when you have not been given the net accounting profit. So for this question ends here. And now what is remaining is the taxation of the limited company, which we are going to look at in our next lesson. For now, we stop there until we meet in the next lesson. After this video, there is some assignments, questions that you can attempt. Kindly do attempt and then see if you can be able to do the way we have done it. Thank you very much.
Hi students, welcome to another session of Manifested Online Classes. My name is Joseph Kimani, lecturer for financial reporting and analysis. So in this session, I want us we continue with the topic number 3 with a special focus on subtopic number 5 regarding presentation or preparation of financial statement by cooperative societies. But before you look on the financial statement which a cooperative society need to prepare at the end of the year, we need to know what is a cooperative society, why is a cooperative society formed, and so on. Now, a cooperative society basically refers to an association or an organization which is formed in order to promote the economic well-being of its members. Basically, what that means is that a cooperative society here is not formed in order to provide services or basically in order to sell some goods now to the members of the public with an objective of making profit. So meaning that a cooperative society here is actually formed in order to promote now the economic well-being of the members. So therefore you can say that a cooperative society yes, so therefore in that case you're saying that a cooperative society here will be formed in order to do what? To promote now the economic well-being of its members and not to provide services or basically to sell goods now to the members of the public in order to do what? To make profit. So mean that whenever, for example, maybe a number of individuals come together, they decide to form something like a SACCO. Basically, a SACCO is a good example of a cooperative society. And we know that those particular members will be forming that particular SACCO in order to make some savings. And if one of the member maybe require a small loan, then he can be able to come to that particular SACCO and be able to do what? To borrow that particular money. So meaning that the objective of forming that SACCO is to promote now the economic well-being, to promote now the economic welfare of who? Of the members. Now, whenever a cooperative society is to be formed, a cooperative society is formed and also registered in accordance with something called the Cooperative Societies Act. And basically, once a cooperative society has been registered in accordance with that particular act, then it is recognized as a legal entity, meaning that a cooperative society do have the same status just like a company. A cooperative society can be able to own property. It do have what we refer as a contractual capacity. It can enter into contract on its own name. It can sue or be sued. It can own property and so on. So therefore, a cooperative society do have the same status, just like what? Just like a company. It is a legal entity. Now, according to the Cooperative Societies Act, we have three types of cooperative societies which can be registered or which can be formed in accordance with that particular act. So therefore, in this case, we can look on the different types of cooperative societies, types of cooperative societies, which may be registered in accordance with what we refer as the Cooperative Societies Act. Number one, we have something called a primary society. A primary society. So when talk about the primary society, this refers to any cooperative society which is formed by individual members. And according to the Cooperative Societies Act, for this particular cooperative society to be formed, it must be formed by a minimum of 10 qualified persons. And actually, for a person to qualify to be a member of a cooperative society, according to the Cooperative Societies Act, such a person need to have attained the age of 18 years. Number two is that such a person must be a resident or basically must own land within the cooperative society's area of what? Of operation. And number three is that that particular person must be within the profession, within the employment within which now the cooperative society is operating. So mean that if, for example, a cooperative society is formed like a coffee farmers, for any person to qualify to be a member, then such a person must be a coffee farmer. So therefore, it is important to note that primary societies are those particular cooperative societies here, which we are saying are formed by individual members. And also we are saying that according to the Cooperative Societies Act, for this particular cooperative society to be formed, it must be formed, or basically it is formed by a minimum of 10 qualified members, or basically 10 qualified persons. Number two, we have something called the secondary cooperative society, or basically we can refer to it as the cooperative union. Cooperative union. In other terms, it can also be known as a secondary society or a secondary cooperative society. And this is a particular cooperative society which will be formed by two or more primary societies. So mean that members of two or more primary societies may come together and they decide to register now a certain cooperative society. That cooperative society now which will be registered, or basically which will be formed, then we say it is formed by a primary society. So therefore, cooperative union is that particular cooperative society which is formed by two or more primary societies, two or more primary societies. Number three, or the other type of cooperative society is something known as the cooperative union. So when talk about the cooperative union, this refers to that particular cooperative society which is formed at the national level, basically to promote the growth and the development of what we refer as the cooperative union. So therefore, it is formed at the national level. The objective of forming this particular cooperative society is to promote the growth and the development of cooperative union. A good example of this particular cooperative society in Kenya is what we refer as Cusco. Cusco basically is a cooperative society which is formed at the national level to be able to promote the growth and development of cooperative union. So we can say Yes, so therefore, what if as a cooperative union? Okay, cooperative union, we can use the word Apex Society. Let's rename this. The appropriate name for that, sorry, should be Apex Society. Apex Society, sorry for that, not cooperative union. So therefore, Apex Society, we are saying, is a particular cooperative society which will be formed at the national level to be able to promote now the growth and also the development of what we refer as the cooperative union. So therefore, according to the Cooperative Societies Act, we have those three types of cooperative societies which may be formed and also registered in accordance now with the Cooperative Societies Act. Now, our main focus here, as the topic suggests, is basically preparation of a financial statement of cooperative societies. And therefore, which are the financial statements which are prepared by a cooperative society? So we can look on those corporate financial statements. Financial statement prepared, financial statement prepared by cooperative societies. First of all, it is important to note here that when we talk about the financial statement, we are talking of the final accounts which are prepared by cooperative societies at the end of the year to basically ascertain their performance, to ascertain their financial position. In this case, we have three final accounts, three financial statements which are prepared by the cooperative societies, and those financial statements include, number one, what we refer as the income statement. Income statement, which is also known as a statement of profit or loss. And number two, we have what we refer as the appropriation account. And number three, we have a statement of financial position. Position. So these are the final accounts which any cooperative society need to prepare at the end of the year. So let's start by looking on what is an income statement and why a cooperative society need to prepare the income statement. So number one, we have the income statement which we also referring to a statement of a profit or loss. And as the name suggests, a statement of a profit or loss, or basically what you're referring to as an income statement, this one is prepared to determine the performance of a cooperative society. So mean that in preparing the income statement or the statement of profit or loss, basically what the cooperative society will be doing is basically comparing the income of a given financial year and what refer as what the expenses or the expenditures incurred during that year. Any difference between the two is actually a profit or what or a loss. So therefore, you can say that this is prepared. It is prepared to ascertain financial performance. Performance of a cooperative society. In other terms, we can say just prepare to ascertain the profit or loss of a cooperative society in a given financial year. So how do we prepare, or how is this statement of a profit or loss presented? So let's look on the format or the layout of what we refer as a statement of profit or loss. Statement of profit stroke loss. Automatically, the one is prepared for a certain year. Yes, so here always we start by recording incomes of the cooperative society. Incomes of a cooperative society. A cooperative society may have various sources of incomes, including things like investment income, and we prepare this account on using vertical format. So a cooperative society may be having something like investment income, things like interest on loans to members. So whenever a cooperative society gives members loans, like a SACCO, the cooperative society, or basically the SACCO, will charge some interest. That interest is basically what? An income. So also a cooperative society may be having the other source of income like entrance fees. If you are you want to join a cooperative society, you may be required to pay some fee. So these are some of the good examples of the incomes of a cooperative society, and then from there you get incomes, the total incomes, and then now to this we proceed and less the expenditures. Less the expenditures, or basically the expenses of the cooperative society. And here we basically deduct now the expenses incurred by the cooperative society in a given financial year. This will include things like maybe salaries and wages to the staff, things like management committee allowances, So a cooperative society is managed by a top organ known as management committee. Things like what? The interest on members' deposit. Cooperative societies, mostly SACCOs, they pay interest which is based on members' deposit, because the SACCOs want to encourage members to continue saving with that SACCO. So at the end of each year, as a member, you are paid some interest which is based on your what? On your deposit. So we take into account that. Then we also take into account other expenses like rent, etc. So we take into account all the expenses of the cooperative society, and we less that now from the total income. So whatever you get here is now the profit for the year. So that's how a statement of profit or loss, or an income statement of a cooperative society is presented, or is what? Prepared. So next, let's look on what is the appropriation account and why an appropriation account is prepared. Yes, number 2, we have appropriation account. So as the name suggests, this is basically an account, or a final account, which is prepared by cooperative societies to show how the profit for the year is supposed to be distributed to the various stakeholders. For example, this account is prepared to show how much amount was paid to the members as dividends, and also how much amount was set aside as statutory reserve fund. Now, it is important here for you to note that under the Cooperative Societies Act, cooperative societies, mostly SACCOs, are required to set aside 20% of their profit as a statutory reserve fund. So therefore, that amount which has been transferred from the profit to the statutory reserve fund, in accordance with the Cooperative Societies Act, it is also shown in this particular what? Account. And therefore, you can say that yes, so this one is prepared to show how the profit for the year was distributed to various stakeholders in form of dividend, in form of transfer to the statutory reserve fund, and so on. So how do we prepare this particular account here? So we can look on the format of the appropriation account. Yes, so in preparing the appropriation account here, always we start with that particular profit for the year, which was determined after preparing now the income statement. Profit for the year, that's what we start with always. And then to this, we proceed and we less dividends which were paid. So if there are some dividends now which were paid, we come, we less those particular dividends here. We also deduct the transfer to the statutory reserve fund, and in this case I've said that the statutory reserve fund, the amount to be transferred to the statutory reserve fund, this one according to the Cooperative Societies Act is always 20% over the profit, 20% over the profit for the year. So the examiner may have given that particular information to you, but equally, if you're given a question for cooperative society, that information still is missing. You have to note that 20% is a must, that 20% of the profit for the year must be transferred to something called the statutory reserve fund. And then after deducting those two items, what we do is that we get now the retained profit for the year. The retained profit for the year. The retained profit for the year. To this retained profit for the year, we add the retained profit balance brought down. The retained profit balance brought down. This is the profit which was retained in the previous year. And then whatever you get down here is the retained profit, which is also known as the appropriation account balance. Appropriation account balance carried down. And this particular balance which we have here, this one will be transferred to the statement of financial position as a component of equity. So this one is transferred to statement of financial position as a component of equity. As a component of what? Equity. So basically that's how the appropriation account is prepared. You can see it is basically prepared to show how now the profit for the year, the profit which was reported during the year was distributed now to the various stakeholders. Finally, I want us to look on how we prepare the statement of financial position. So number 3, statement of financial position. Now, when talk about this one, statement of financial position, formerly known as the balance sheet, this one is prepared to show the financial position of a cooperative society at the end of the year. In other terms, this is a statement of asset, liabilities, and equity, and this one always has to be prepared based on something known as the accounting equation. So we can say that this. Yes, so therefore this is a statement of cooperative societies assets, liabilities, and equity as at the end of the year. On the other hand, we can say that it is prepared based on the accounting equation. Yes, so therefore this one we prepare it based on the accounting equation. The accounting equation is an equation which states that assets are equal to capital plus liabilities. So let's look on the format, how we prepare a statement of financial position. And actually this one we abbreviated as SOFP, statement of financial position, which is prepared as at the end of the year. So always we start by recording assets. And when preparing a statement of financial position for a cooperative society, is not a must. There is no need of classifying the asset into non-current, and current. Just like what the banks do, we record the asset of the cooperative society starting from those assets which are liquid. When talk about assets which are liquid, we are talking of asset in form of cash, and then followed by those assets which are highly liquid, those assets which can be converted into cash within a short period of time, and finally we record now the long-term asset like the PPE and so on. So therefore, we start by recording assets. We start by recording assets. In this case, I've said we don't classify the asset into non-current and what? Current. So when recording the asset, what is important here is you start with most liquid assets. Most liquid assets, and finally record long-term assets. Long-term assets. So meaning that here we start by recording things like the cash and bank balance, cash and bank balance, and then next we record things like investments, investment. We also record things like loans to members. Whenever something like a SACCO has given the members some loan, that is an asset the cooperative society expect the members to repay back those particular loan. And then you finally record the long-term asset, such as now the PPE, property, plant and equipment. So therefore I've said here no need of classifying the asset into non-current and current, and then from there get the total assets. Next, we record now the capital and the liabilities. And remember what I've said is that the cooperative society here do have the same status just like a company. So therefore for capital we record, or the capital, which is also known as equity. This comprises of share capital, things like members' deposits, and the reserves. So therefore, let's look on what we record under equity. So next we record equity. And equity, I've said that this comprises of share capital and what? Reserves. So we record the share capital. We also have the members' deposits. So it is important to note that if maybe the cooperative society we are dealing with is something like a SACCO, members will have made some deposit with such a SACCO. But generally, as a member of a SACCO, you can't be able to withdraw that particular amount of money anytime you want. So you can only be able to get back that particular amount of money if now you do what? You want to quit from that particular cooperative society. So mean that particular amount of money which you have deposited with your SACCO remain with the SACCO. The SACCO uses that as capital, because mostly SACCOs use that money in terms of giving loans to members, and that's why you can see we are treating that as part of capital. As part of what? Capital. So we record other items of equity, like the statutory reserve fund, fund. I've mentioned something to do with this, and then things like the appropriation account, and other reserves like the revaluation reserves, etc. Yes, so those are the various items of equity, and then get the total equity there. And finally record liabilities. Equally here, when recording the liabilities of a cooperative society, no need of classifying them into non-current and also what? Current. You just record all the liabilities here, which include things like things like creditors. The amount of money which is owed to the creditors, any accrued expense, any accrued expense, etc. Yes. So record all those particular liabilities there, and then proceed. You get what? The total equity and liabilities. Total equity and liabilities. And whatever you get here is the total equity and liabilities, always it must be equal to the total asset, simply because we prepare that statement of financial position based on the accounting equation, which states that assets are equal to capital plus what? Liability. So therefore, that's how we prepare or basically present this particular statement of financial position of a cooperative society. So that brings us to the end of that session. In our next session, still in this on this particular subtopic here, we are going to look on an illustration question regarding presentation or preparation of financial statement of a cooperative society. So see you in the next class.
Hello learner, welcome to Manifested e-learning platform. My name is FAM Lingwiri, and today, ladies and gentlemen, we are discussing about the financial modeling and data analytics paper, December 2023 sitting. The focus is on question 23, and you are presented with the following information right on the left of your screen here. You've been given the stock name, Z-Term Kenya Limited, Car Assemblers, Ujenzi Centum, Cement, Kilimo Bora, Nairobi All Share Index, and you've been given the ticker symbol right over here. You've also been provided with the portfolio compositions, and all of these total to 100%. And how you can be able to just quickly check is by scrolling down over here, and you can see that the sum is 100% right here. You are presented with the weekly returns for all of those companies, or all of those 4 companies, including the Nairobi All Share Index. Now, you are required to calculate the weekly returns for each of the individual stocks and the Nairobi All Share Index, calculate the wage portfolio, the average portfolio return for the historical period. You're told to calculate the standard deviation for each of the individual stocks and the Nairobi All Share Index. Then you're told to calculate the standard deviation for the portfolio returns to assess its risk, and to calculate the beta each individual stock of the portfolio, which measures its sensitivity to the market movements. And you can see these are 20 marks. This is 20 marks question. So the way I've decided to arrange the information is to arrange it as you can see on the right of your screen over here, to calculate the weekly returns for each of the individual stocks of the Nairobi All Share Index. So we just pick average, not average A. You can see the average right over here, and the average of what? We want to pick the average for Z-Term Kenya, to pick the average values right here. Up to there, close the brackets, then you enter. So we're saying that the average return should be negative 0.2%. Let's put it to maybe say 2 decimal places. That 2 decimal places is up to there. And if we were to drag it moving towards the right, we wouldn't be wrong, because we're saying that it picks the average for car assemblers. You can see car assemblers, it picks it right there. So that's what they're saying, the average, the weekly returns is given to us right there. Escape. We move ahead and answer part B of the question. You're told to calculate the average portfolio return over the historical period. We have been given the portfolio composition, and the portfolio composition can be linked with this top part right here. The portfolio composition is there. Enter. And we link it with all of them towards the right, control R, like that, so that you can be able to pick the portfolio composition. Remember, we have computed the average weekly returns above here. So we just link it with up above there, and then we drag it, Control R, like that, the same values, excluding the all share index. Because this, all of these portfolio composition total to 100%, as you can see down here, we cannot be able to include the all share index into our portfolio. How do we get the average portfolio return? Pick plus, we open the brackets, that value times the average weekly return plus that value times that value, close the bracket, the portfolio composition multiplied by the average weekly return, close the bracket, and then we add finally the portfolio composition for Kilimo Bora, and we multiply that with the average weekly returns, like that. Oops, that, close the bracket, and we enter. So I think I didn't put open a bracket here, that's why it's giving me those values there. So we open a bracket over here, and then once we close it like that and we decide to enter, it will actually be okay. So we only want it into the 2 decimal places, so we just sort of reduce it like so to 2 decimal places, like that, 0.35%. Now once we've gotten our portfolio return as 0.35%, we can move on to part C. Calculate the standard deviation for each of the individual stocks and the Nairobi All Share Index. That's 4 marks. So average standard deviation would be, you pick STD, stud dev, not P, because we're not picking for the entire population. We want stud dev, standard deviation for the sample. So we double click that, and we can be able to just pick the value for these values here. We highlight this value for Z term. So we highlight it down like that, and it picks to calculate for us the standard deviation for Z term. And we move up over here like this, we can be able to see we already have that given to us there. And if we were to drag it moving towards the right like so, up till all share index, it will actually pick the standard deviation. Remember, for example, this one is picking the standard deviation of the sample for the index, for the Nairobi All Share Index right here. Part D, we asked to calculate the standard deviation of the portfolio returns to assess the risk. And we're saying for us to be able to do that, we will need to consider the weights. And the weights would mean that we've already had the standard deviation over here, compared to us over here, but now we need to factor in the weights. And we're saying it's going to be, we pick that standard deviation times its corresponding weight over here. The corresponding weights were given to us over here. We can use that, or we can even use this portfolio composition right over here. So we close the bracket and we open another one over here so that it can actually pick the values as the way we want them. Then we add the standard deviation over here. I forgot to open the brackets, so we open it right above over here. You can see it on the formula bar here, so we open the brackets there, and then we multiply that with car assemblers corresponding portfolio composition weight. We open the brackets, we pick Ujenzi Bora standard deviation, weekly standard deviation, times the Ujenzi cement over here. Then we close the brackets, plus we pick this value here and we multiply that against that value there. Open the brackets and we close the brackets like that, and we just click enter. So we can be able to put it in form of weights, and we can say it's about 6.02% standard deviation. So standard deviation of the portfolio is given to us there. So we pick the standard deviations of the individual securities and we multiply them by the corresponding weights. Then finally, we are asked to calculate the beta for each individual stock in the portfolio, which measures its sensitivity to market movements. The beta is given by covariance of the market and stock, so you can put it like so, covariance of the market and the stock. Then we divide that against the variance of the market, like that. And that's what we're saying we're going to do. Covariance of the market and stock of variance of the market. So we pick covar S, because we're looking at a sample, covariance, and we open it up right over here. Covariance of what? Covariance of the market. This is the market over here, so we highlight that part. Covariance of the market, and on the second array here we put the stock itself over here, bearing in mind, like that, covariance of the market and stock, like that, and you can see what we've done, covariance of the market and stock. So we can lock the one for the market, So we are saying this one for G is one that you can be able to decide to lock. F4 and F4. Why are we locking it? Because we want to ensure that the covariance of the market remains like that. And then we do what? We divide now, divide by, you can see the variance like this. We divide against variance, or we just put it like that, variance of the market. But now, before we do the variance like that, we can say okay, like that, because that's just the covariance, like that, because you can see from the formula by just the covariance. Then we continue and say divided by the variance, not var P but var S, sample, variance of the market, based by this variance of the market. So we pick the variance of these values here and we lock it. So we press F4 like that and we close the brackets. That there, that's our beta, 0.0932. And if we are to drag it moving towards the right, let's just confirm. Covariance, remember we have locked, that's the purpose of locking. This one, covariance of the market. Look, this one has moved from initially Z term to now car assemblies. You can check the previous one over here, escape, check the previous one, you see it is now currently at Z term here. Now we move on to the second one, it actually picks, but it remains, this one remains, the variance of the market remains, the covariance of the market remains. So we can be able to say that the model is foolproof. Control R. But let's see if we're actually doing this the correct thing. We want to try and prove if we were to pull it towards the right, if you're going to get a beta of 1. You can see we already have beta of 1. Beta of the market is always 1, because it's covariance of the market, it's covariance of the market against the market divided by variance of the market. We always have that value being 1 there. And so with that, ladies and gentlemen, we have come to the end of question 23. Thank you for being with Manifested Publishers. We always here for you. Be blessed.
Hi students, welcome to another session of Manifested Online Classes. So in this session, I want us we continue with the topic number 3, subtopic number 5, financial statement of cooperative societies. And specifically on this session, I want us we look on an illustration question regarding presentation of financial statement of a cooperative society. So I want us we go through the illustration and then we see what was required. So we are told Marura Farmers Cooperative Society deals in